Hello, and thank you for joining today's webinar on understanding the Paycheck Protection Program, hosted by Economic Innovation Group. My name is Catherine Lyons. I'm the Manager of Policy and Coalitions for EIG. I am joined by John Lettieri, EIG's President and CEO. We are pleased to welcome our guest speaker, Caleb Orr, Policy Advisor to Senator Marco Rubio, who serves as Chairman of the Senate Committee on Small Business and Entrepreneurship, and who took a leading role in crafting the Paycheck Protection Program that was passed last week as part of the CARES Act. Over the coming weeks, we will also continue to make new insights, analysis, and helpful resources available on our website. And so with that, I will turn it over to John Lettieri to get us started.
Yeah, thank you, Catherine. Welcome, everybody. Glad you could be with us for this important webinar. As all of you, I think, will know, that the Paycheck Protection Program kicks off today with applications beginning to be processed by commercial lenders around the country. So we're very proud to be able to offer this as a resource and welcome Caleb Orr from Senator Marco Rubio's office, with whom we worked closely in the past on a number of policy issues, and who was, as Catherine said, instrumental in putting this program together. There are a lot of questions and a lot of interest in getting tangible information about how to go through this program, who it targets, what the purpose behind it is. And so what we want to do is to allow Caleb to kind of kick us off with the big picture. What was the vision for policymakers in putting this together? What do they hope to see it accomplished? And throughout the course of the webinar, we're going to cover not just how the program works, how to apply, what are frequently asked questions, but also what we may be able to expect next, as Congress is still doing and continues to do more work on the response to the COVID pandemic. So I think it's safe to say that this is not the last bit of legislation that they'll have, and that the currently appropriated $350 billion for the Paycheck Protection Program may not be the last of what gets appropriated for this down the road. So we hope to cover a lot of ground, and as Catherine said, we're dealing with very high volume here today, so we'll do our very best to get to everybody's questions and to get to questions that we know cover a lot of different areas of interest across the participant list. But we're not going to get to everybody's questions, so please be patient with us as we try to navigate quite a few incoming requests throughout this process. So with that, I'll hand it over to Caleb to walk us through the background and goals of the PPP, and then we'll get into the agenda.
Thank you, John, and thank you, Catherine, and thanks to EIG for hosting this webinar and for all the work that you guys have done on the small business lending issue. From putting out the white paper before this entire process began, to working with us in drafting, and now working with us on the implementation side, you guys have really been instrumental as well. I'm Caleb Orr. I'm Senator Rubio's project director on the Small Business Committee. And Senator Rubio is the chairman of that committee, and he was the leader of the Small Business Task Force in the Senate in drafting Title I of the CARES Act. What John and Catherine have asked me to do is to start this off by talking about how Senator Rubio and other members thought through their policy goals for the Paycheck Protection Program and how we arrived and designed the Paycheck Protection Program to meet those goals. The first thing to say is that when the members were looking at what we should be doing with small business, there was an initial paradigm of saying we need to preserve the organizational capacity of our small businesses. I think perhaps the economic efficient thing to do in this situation would have been to allow for the unemployment benefit system to pick up laid off workers temporarily, which they could then rejoin the businesses after this is all over. But what Senator Rubio and others really pushed for was a system that would allow small businesses to maintain the employee-employer relationship. Because we know that at the end of all of this, in a very uncertain period, there's not going to be necessarily an immaculate adjustment in the labor market. And there's great value stored in the current employee-employer relationships due to how strong the labor market has been in recent years. And that's something that we should want to preserve at great cost, including programmatic inefficiency. And so in approaching this problem, the senators wanted to come up with a way to preserve that relationship and preserve the value and the organizational capability that small businesses have with their employees. And moreover, Senator Rubio's understanding of this situation is that for a lot of folks during this time, what hurts most is not necessarily the absence of income, although obviously that's important, but the uncertainty of not knowing what will be there for them when this is over. In Senator Rubio's understanding of the issue, people can get by with a little less income, but what is really devastating during this time is not knowing that you'll have a job to come back to. And so with that in mind, we designed the Paycheck Protection Program in order to achieve the goal of preserving those relationships. To speak now about the approach that was taken and why we went through the SBA, this was essentially a project of deciding how can we build a financial infrastructure to get money to businesses and verify their ability to retain payroll during this time. And for all of the options that were available, and I think, speaking frankly, as second best as the SBA can be at times, the SBA did have an existing system of about 800 banks that have what is called delegated authority. And this means that these banks, they make lending decisions with the stamp of the SBA's approval, and the SBA will come back in twice a year to verify those decisions. But it's not the SBA that is making these lending decisions, it's the banks. And so within the SBA 7A system, there already was an outstanding financial infrastructure that could be built upon. And for all of the bumps in the road that have occurred in rolling this out, the members thought that that was better than having to set up a new system entirely. And I think we're in seeing how the Federal Reserve is beginning to set up its Main Street lending facility. We're grappling with some of the institutional design questions of how you're able to interface with small businesses. And so building out from the SBA 7A infrastructure, what we did was, in the Paycheck Protection Program, we created a new paragraph within Section 7A of the Small Business Act, which is the SBA's flagship lending program. What that program is a loan guarantee program. The SBA will underwrite or guarantee the loans that are made by these banks with delegated authority. The traditional 7A program has a guarantee rate of 75% for some loans or up to 85% for other loans. And in the Paycheck Protection Program, we increased that guarantee to 100% to eliminate entirely the credit risk that banks face in making these loans. And so the 800 banks that are within the system that already have this delegated authority already have the SBA infrastructure in place to make SBA guaranteed loans and to interface with the SBA for the SBA to purchase those guarantees if there's a default. So building upon that infrastructure, we increased the size of the loan, we increased the guarantee, we waived all sorts of fees and other underwriting requirements that the SBA traditionally requires of their member banks. And then we added a new element of loan forgiveness in order to encourage businesses to keep payroll. The thinking here is that businesses keeping payroll during this time is providing a sort of public benefit, as I mentioned earlier. And so it was justifiable to have an element of loan forgiveness because we're justifying that public benefit with a public cost via a taxpayer-funded forgiveness of the loan. And so in adding this element of loan forgiveness, what these loans have become is essentially grants. And we're using the existing SBA infrastructure to facilitate those grants. Instead of having the SBA or the Treasury or some other government agency have to check the applications of all sorts of businesses, really millions of businesses in the country that will be seeking this relief, they can go to their existing bank that they have a lending relationship with, and that bank can issue the grant under the SBA certification. Now, in administering the program, there have been a number of issues that have come up that I'm sure we can get into in the questions. And there are, I think, a number of outstanding questions that remain for how the SBA will verify these things. I just wanted to speak briefly, though, about the loan forgiveness and how the program will work on that front. The loan forgiveness is intended to reward employers that keep their existing employees. And so the loan forgiveness will, the amounts that are spent on payroll and on other fixed costs will be forgiven, but then the forgiveness amount will be reduced proportionally by any reductions in employees relative to a prior period, relative to the period prior to the coronavirus public health restrictions. We have some exemptions for rehiring. We have exemptions for some level of pay cut. And then we also have the authority for the SBA and Treasury to issue de minimis exemptions as well for other edge cases. But that was an important component of what the members wanted to achieve here, which was to make sure that this forgiveness was tied to keeping employees on payroll throughout this process. A brief comment too about how it's going so far. Just as of an hour ago, I was notified that the program had issued over $1 billion in loans as of noon. The SBA has taken in over 2,000 applications from banks to become SBA 7A lenders. And so the program is beginning to ramp up, and the SBA and Treasury are dealing with regulatory issues as they arise. So with that, I think I'll kick it back over to John and EIG, and we can start walking through how the Paycheck Protection Program works.
Thanks, Caleb. I just want to return quickly back to the issue of the hiring retention piece and the rehire piece. For a lot of businesses, including a lot of folks who may be on this webinar, their business made layoffs before the bill was passed. And so it's important to emphasize that the bill provides a pathway back to eligibility for loan forgiveness for firms that made those short-term decisions but are in a position to rehire. Can you just walk us through that a little bit?
Yeah, sure. That's a great question. So recognizing that many businesses had already made layoffs at the time that we're passing the CARES Act, and what's really remarkable about this entire legislative process has been how rapidly I think the conditions on the ground have made redundant or inapplicable the conditions that the legislation was considering in other parts of the bill as well, is how now, with the unemployment claims from this week, how many more have already been laid off. So recognizing that, we incorporate a degree of flexibility where if a business, at the time that they take out the loan, if they had already experienced some reduction in their employees on payroll, there's a time window up to April 26th that allows the business to bring employees back on payroll, and the reduction that they had at the beginning of the period will not be counted against them, so long as that by June 30th, they have everyone back on payroll. And we expect some regulatory exemptions in that space as well. But that's, I guess, broadly, John, the message is if you bring on your employees back on payroll, then your initial reduction that you start the loan period off with won't be counted against you.
So June 30th, that's the really critical date for full rehiring.
That's right.
So let's, with that, let's go back through and we can kind of break this down piece by piece per the slides that we have here. Caleb, why don't you just walk us through that? We've got the key elements laid out here, including starting with the covered loan period, and feel free to fill in any additional details as we go through this.
Sure thing. I think so. We can just go in the order of the slides that EIG has produced here. Where we start is the covered loan period. The covered loan period is February 15th through June 30th. This period was enacted in order to cover the broadest scope of businesses that have been harmed by this possible, starting back to February 15th. And so loans are made available during this period, and it goes back to February 15th for a reason, because the idea here is that businesses can take out loans. If they've kept employees on through this whole period, they can use some of the loan forgiveness to cover any payroll costs they experienced prior to taking the loan as well. And so this allows, we think, for businesses that have been hit prior to the bill's passing but have been able to keep their payroll to benefit from the program. And then it goes through June 30th in order to cover as long as a period as we think that this situation might go on. We've heard a lot from businesses about the limitation of the loans coverage of payroll to 8 weeks. We certainly hear that, and I know that some states like Virginia, for instance, have already established public health restrictions that go for 10 weeks or longer. And so I think there's a lot of support in Congress. We can talk about this later on, but I think there's a lot of support in Congress to extend the program if it works. And if it's true that these public health restrictions will continue in a substantial way beyond 8 weeks. The Treasury and SBA regulation has announced an application period starting today. Small businesses and sole proprietorships can start applying, and then next Friday, April the 10th, independent contractors and self-employed individuals can start applying as well. I know there are a lot of questions about the status of independent contractors, both as applicants themselves and as how they count on other small businesses' applications as payroll. We can get into that as well, but in general, the filing process for independent contractors and self-employed individuals is more complicated and will require further regulation in order to clarify for lenders how these loans will be processed. And so we expect further guidance to be coming out on that next week prior to the April 10th application date. Eligible businesses. The statute provides for a very broad category of eligibility, which includes the existing Small Business Administration definition of small businesses, tribal business concerns, nonprofits and veterans organizations that file in 501c3 or 501c19 of the tax code, but then also more generally, any business concern that has less than 500 employees. The SBA also has an industry size standard that has, for each industry, a number employee count that under which the business is defined as small business. And so if your business is in an industry that is above 500 employees by the SBA's count, then you can be included under that standard instead of the 500 employee standard. And most of those businesses are in manufacturing industries. We can, John, I guess at this point on business eligibility, and I don't see in the rest of the slide deck anything on affiliation, so I'll just do a brief comment on that here. When we define what it means for a business to have 500 employees, there are all sorts of questions about franchises. So if you have one Burger King, is it looped in with all of the other Burger Kings for the purposes of defining whether or not they have 500 employees or not? And those can be complicated questions. The SBA already has a rule system for defining affiliation, and it allows a fair number of franchises to count. So in the example I just raised, the way the legislation would work is the franchisee would be the one applying, not the corporate parent. So if a franchisee owns 5 or 10 Burger Kings, then they would be the one applying instead of the Burger King corporate organization, Restaurant Brands International. There are some other changes made in affiliation rules in the statute that we can get into in the Q&A. But moving on to the maximum loan amount, the maximum loan that a business can get is 250% of average monthly payroll cost, up to $10 million. There are a number of ways that businesses can define their average monthly payroll cost. It can be the year prior to the date that they were applying for the loan. But if you're a new business, and so you don't have a full year of prior payroll, then it can be your January and February payroll. On the SBA Express loan, if there's an SBA 7A product that's a credit line product, we increase the maximum value of the credit line that you can draw down from the current $350,000 to $1 million. And that's a separate part of the legislation. That's not a Paycheck Protection Program loan, but that's an additional benefit that some businesses will be able to take advantage of. The allowable uses of the loan are your payroll costs, any other worker compensation that we have in the legislation, which is a pretty broad list that includes healthcare benefits, and then also a fixed cost on all sorts of debt obligations that were incurred prior to you taking out the loan. So it includes mortgage interest, rent, utility, and any interest on other debt obligations that were incurred prior to February 15th. I already spoke about the eligible lenders. We in the statute declare, even without SBA having to lift a finger, that those 800 SBA banks plus all of the additional current SBA approved banks in their entire system are given this delegated authority to start making these loans automatically. And then we give Treasury some broad authority for on-ramping new banks and new non-bank lenders even into that system and receiving that SBA delegated authority. The loans have a 2-year maturity. This is supposed to be a loan that you're using for current costs, not for long-term fixed assets. And I guess before really discussing more about the loans, it's important to recognize that because a significant amount of this loan will be forgiven, the loan maturity and the loan interest rate and other features of a loan really only come into play to the extent that there is principal that's in excess of the forgiveness amount. We expect, and the Congressional Budget Office expects for its scoring purposes, that the vast majority, upwards of 99% of the loans that are made under this authority will be forgiven and not remain as outstanding loans. But in the event that they do remain outstanding, the maturity is 2 years and the interest rate is 1%. But any payments on those outstanding loans are deferred for 6 months. And so, yeah, I think that about covers the features of the loan to the extent that it becomes a loan. For applying to the bank to receive a loan, there are no fees that the bank has to pay the SBA and no fees that the borrower has to pay the bank. The bank doesn't have to check for any of the traditional checks that it has to go through an SBA. It doesn't have to check if the borrower has credit available elsewhere. There's no collateral or personal guarantee required of the borrower. All really that's required is a good faith certification that the economic uncertainty of our present moment makes the loan necessary and that they will use the loan to maintain payroll and make other required payments. The most critical thing to talk about here is the interaction with the Economic Injury Disaster Loan, or EIDL, as it's referred to at the SBA. This is a separate loan, the Paycheck Protection Program loan. It's time limited. It shares a lot of features with the 7A loan guarantee program, and it relies on the 7A infrastructure in order to work, but it is not 7A. The way to think about it is that as I mentioned in the overview, is that it's a kind of 7A on steroids insofar as it has a larger guarantee, larger amount, and that it's utilizing the existing 7A infrastructure. There's been a lot of confusion about the Economic Injury Disaster Loans, or EIDL, insofar as people think that the EIDL is the same as the Paycheck Protection Program. The EIDL, which is something that you apply for online directly through the SBA, is the longstanding SBA disaster loan program, which is a direct loan that's made from the SBA to the borrower. It's not a loan guarantee that the SBA guarantees through a private intermediary. It's directly through the SBA. And the SBA told us, last night that there had been over 2 million applications to the EIDL loan application online. And so while we think that level of demand makes some sense, the terms really are better under the Paycheck Protection Program. I think the reason why EIDL has been promoted as it is because it was already existing prior to the CARES Act. So we're really engaging in an information campaign right now to make sure that small businesses are aware that the better thing to go into at this point is the Paycheck Protection Program because it can be forgiven, whereas the EIDL is not forgiven. And additionally, you're going through a private bank instead of having to go through the direct SBA application process. There is an important interaction that I'm sure we will have questions about, but for borrowers who already took out the economic injury disaster loans, who already took out EIDLs, they will be allowed to refinance those loans into the Paycheck Protection Program. So if the borrower took out a loan that was over $10 million, which is over the Paycheck Protection Program cap, then you're allowed to bring that amount grandfathered into the Paycheck Protection Program, and then also use all of the Paycheck Protection Program loan terms instead of the EIDL loan terms. One feature, though, that was added in the CARES Act is a grant-making feature within EIDL. So up to $10,000 of an EIDL loan can be made in advance as a grant to the business. And so that's a bit of a new feature that makes EIDL still attractive. And so for some businesses who might have more discrete costs that they think they can manage, then perhaps the grant makes some sense. But in general, the much more lucrative program is the Paycheck Protection Program. For how this interacts with other SBA loans, you can only get one Paycheck Protection Program loan, and you can't get another SBA loan for the same and duplicative purpose as the Paycheck Protection Program loan. The other SBA loans are still available, but they don't incorporate any forgiveness elements. And so we have not heard from a lot of small businesses that are looking to take out an SBA loan to buy up a fixed asset these days. That about covers it for the SBA, and I'm happy to kick it back over to John for any questions that EIG has, what would be helpful to talk about, or audience.
Catherine, I'll leave it to you. Should we move into the application process, or do you have something else to add here?
Yes, no, I think we can move into how to apply. So I'm on this slide now for folks that are following along. We have compiled here a list of resources, including the final borrower application form for these paycheck protection loans. As noted earlier, today, April 3rd, is the day that the applications are open for small businesses. And here as well are a list of other resources that hopefully kind of complete what you will need along with this webinar to fulfill that application and start putting together documentation for application of those loans. So we've listed that here. As I mentioned earlier as well, we will be circulating this recording to registrants afterwards, so you can have this information at your fingertips as well. So moving on to the FAQs. So we received quite a few questions ahead of this webinar, as well as just have been gleaning questions that we've received over the course of the last week since the passage of the CARES Act. So I will turn it over to Caleb again to start going through some of these FAQs, and then we can turn towards some of the submitted questions that we received from the audience as well.
Thanks, Catherine. All right, so on the slide, we're on slide 8 for beginning the FAQs. The first frequently asked question is if paycheck protection loans can be used in conjunction with other SBA loans. I think, as I mentioned earlier, just now, they cannot be used for the same purpose. And we expect that in this time that the payroll needs will be more than enough to make the paycheck protection loan enough to work. I guess one other thing that might be worth raising here, though, is that for businesses that already had SBA loans, we have included a payment on those loans where there's no payments required on any SBA loans that are outstanding right now. For the second question, if the loans can be used to pay full-time employees or 1099 contractors as well. In general, although there will be regulations coming out next week, independent contractors should apply on their own, not be paid through their clients. Although, like I said, those regulations will hopefully make the split between those two things more clear. The third question, if paycheck protection loans can be used to pay owners of the business, owner draws on sole proprietorships. That's what the statute envisions for sole proprietors, that the owner's income is their payroll cost. And so for up to an annualized amount of $100,000, so for whatever a $100,000 annual salary would be for that period, can count as a payroll cost for a sole proprietor. And so they'll be able to get loan forgiveness for that amount of the loan. And I guess the next question links well to that. The exclusion of salary in excess of $100,000 does not mean that any employee that makes over $100,000 is excluded from the loan forgiveness. It just means that only the first $100,000 of compensation can count toward the payroll cost definition for the purposes of loan forgiveness. And so if you have an employee that's making $150,000, the firm will be able to book $100,000 as a payroll cost, not $150,000, but not zero. For the next question, if a borrower does not have an existing relationship with a bank, that is something that Treasury is working on. Something that has come up a lot today. I know many people have probably seen Bank of America's notice that they're only lending to existing debtor relationships. The current Treasury regulation is such that for the purposes of complying with the Bank Secrecy Act, which is an anti-money laundering statute, it's only existing debtors that you don't have to file any new BSA paperwork for. And so I think there's a time question to that regulation and why that's working the way it is right now. Senator Rubio is working on fixing that, frankly, and getting that regulation to be lifted a little bit so that we can have new borrowers go to banks, but also Treasury has some broad authority to on-ramp new lenders, including non-bank lenders, as fintech institutions or others. I know that's been in the discussion, and they will have to have some anti-money laundering requirements to meet as well. But those sorts of lenders will have a much broader network of existing clients for which this might make sense. For the next question, for what a bank's going to ask in the loan application process, the EIG link to the Treasury website that has the borrower application has all of that at this point. It's been tried to be streamed down as much as possible to your current payroll costs, your current employees, your prior employees. There is an important question for to make sure that your employees are all to have a principal place of residence in the United States. You don't get to claim forgiveness for foreign employees. And then a number of other questions such as past criminal activity or if you defaulted on any loans in the past through the SBA. But that application has all of that information for the borrower. Catherine, that about covers it, I think, on the slide 8 FAQs. I know there are others that are commonly asked that I'm happy to get into from the agenda or defer to you on how to handle the rest.
Let's do that. I think, thank you very much for going through that. Let's go through some additional FAQs from the agenda and others that you're hearing as well, especially as applications are now underway and folks are starting to apply.
Okay, I think an important outstanding question is for banks, And actually, I think I'll start off perhaps with a bit of I think a regulatory priority overview. The way that we've been viewing this is that there are 3 buckets of regulatory certainty that are needed. And they come in a sort of logical order of priority that's also time sequenced. The first is lender certainty, making sure that the financial infrastructure is up and running and making these loans. And that's been the major focus this week. I know that there's been lots of news and frustration about that, but in getting a program this large off the ground, that kind of rollout can be expected. And as I said earlier, that we've just crossed the $1 billion mark, and so we're really trying to get that up and running. And there are some important questions that are outstanding still that we're working to resolve on how banks will be able to access liquidity. The Federal Reserve has announced, a Main Street lending facility for which there is eligible collateral. An SBA loan counts as eligible collateral to receive liquidity from the Fed. So there will be some important interactions to work out there. The second priority is the borrower eligibility. And the reason why this is second to the lender certainty is that there are already tens of thousands of small businesses that clearly qualify under the old SBA size standards, that if we're able to get the financial infrastructure up and running, banks can lend to them with high certainty, and we need to get those out the door as quickly as possible. And once that infrastructure is up and running, then we can start resolving borrower eligibility questions based on the statute and include them into the system. And there are a number of borrower eligibility concerns to think through. I mentioned earlier the affiliation rules for defining whether or not a small business should be affiliated with any other business or investor for the purposes of deciding if they actually are a small business. So there are a lot of affiliation issues to resolve there. And then the third bucket is the forgiveness verification. In the time sequence of it, this is the last one, although I think it's perhaps the most important because this is going to determine how much forgiveness actually occurs for the business. But the first forgiveness amounts will not be made for at least a few weeks. And so in terms of timing, it's not as necessary for getting the program up and running or deciding who is eligible to begin with. There are many important questions here for defining, what was your payroll cost? How do you verify what the payroll cost was? How do you count your full-time equivalent employees during this time? How much loan forgiveness do you have reduced based on your reductions in employees? How does the rehiring exemption work? Things like that. Those will be important regulatory questions as well. But those are the 3 ways that we see the regulatory priorities. And I think starting next week, we'll get to more work on these borrower eligibility questions now that the financial infrastructure is starting to start running. I will go through these FAQs now from the agenda. The first is, let's see, let me make sure I've got the right here.
And Caleb, also there, I think just going back to the FAQs that are on this slide, particularly I'm not sure if we covered fully the one about small business owner that's taken a draw, and if that would be able to count toward payroll costs. Could you touch on that a little bit more? That's a frequent question. Thank you.
Right. Yeah. Yes. No. So the congressional intent here is that for the purpose of defining payroll costs, the owner's draw is a payroll cost like paying an employee. Now, there are important there's an important regulatory consideration for it. Let's say the owner has taken a pay cut or something. Does that count against does that count towards reducing forgiveness because you've done a pay cut for an employee? in that case, the owner should not be considered as an employee, but in general, the owner's income should count as a payroll cost.
Okay, great. Thank you for that. Additionally, the paycheck protection loans being used in sole proprietorships. So again, I think maybe you covered this, but just trying to go through as many of the potential structures as possible, for folks, and that may be a common one as well. So anything to note related to sole proprietorships in particular. And I know that some additional regulations here may be forthcoming.
Sure. So sole proprietors are eligible as of today, and I guess, so sole proprietors in general, I think, are less tricky than some of the independent contractors, self-employed, or LLCs in particular. So yeah, I think, they should be eligible to go today. I'm happy to answer any discrete questions about what that filing status causes, but in general should be good to go as of today.
Great. Excellent. So yeah, let's, in terms of additional FAQs here, so I think we're getting a lot of general, and I think you touched on this a little bit, but just getting a lot of general questions in the chat about banks either asking for perhaps some different qualifications, or saying that they're not yet accepting applications as of today. Any advice to folks that are also looking for banks that maybe, or who don't have an existing relationship yet with a bank, and how to move forward with that? What are some resources where people can find existing lenders that are ready to go today in processing those applications?
Yeah, so I think sort of as I mentioned earlier, we're aware of the existing customer requirement that some banks are requiring to get going. Our expectation is that that's just something that is required to get going, and that opening the pool up to others is more of a time question than a policy question, because it requires filing some extra Bank Secrecy Act paperwork. We are very interested in involving new lenders that have all sorts of existing client relationships in order to expand the pool of applicants. Lender capacity is a huge issue for Senator Rubio, and so Treasury has the ability to on-ramp new lenders, and we're working with them to expand that pool as we speak. Like I said, the SBA has already also received over 2,000 applicants from lenders to become SBA lenders, and I know that they've got a whole team that are working on processing those applications.
Caleb, I have a question about the process going forward. You had mentioned that $1 billion in loans have already been approved, and at that rate, the $349 billion that's been appropriated for this could go relatively quickly. How are you all evaluating the drawdown of those resources? We know that Congress.
Sorry, John, did I lose you?
Let's just give him 1 minute. In the meantime, some of the other questions that have come up. One is the loan forgiveness taxable? The statute makes it very clear that whatever amount is forgiven will not be treated as taxable income for the business in their 2020 tax filing. Others have asked about nonprofits, such as 501c4s. To our knowledge, a 501c4 would not be eligible. They've laid out pretty clearly in the statute that this is primarily 501c3s. In the nonprofit sector, and we provided more information on that in the slides and the breakdown. So there will be some types of nonprofits that do not qualify as eligible for these loans.
I believe Caleb's back on.
I was going to ask about the drawdown of the resources. So you mentioned that $1 billion have already been out the door. At that rate, could go relatively quickly. How are you and Senator Rubio and your colleagues keeping tabs on that drawdown. And if we look ahead, word right now is that the Senate will be back April 20th or thereabouts. As you prepare for what more may need to be done, are you considering not just extension of the amount available here, but also some of the specific features? You'd mentioned one aspect that Senator Rubio is working on now related to the regulation, but how much of this will evolve over time? What can people expect in terms of additional resources and next steps?
It's a great question, John. I know that there was a lot of coverage of saying that this program is underfunded, and I know that I think everyone thinks that this program will be oversubscribed. Just can tell you that the members that were drafting this were well aware of that risk, and I think there's, the important thing is getting the program working correctly, making sure that the infrastructure works, making sure that this is a program that works for small businesses. And if we get that right, I think there's going to be a lot of support for expanding it as needed.
That's great. Catherine, do you have other questions about the PPP that we've gotten in from others, or other FAQs that we haven't reached so far?
One that's come up actually, and this may be forthcoming regulatory guidance on additional lenders. There's some questions about if CDFIs or kind of other banks, community banks, will be able to eventually qualify as lenders to make some of these loans. Is that just information forthcoming? As I know Treasury is thinking about adding additional lenders beyond the normal scope of SBA 7A lenders, and when do you expect that we may see guidance related to that?
Yeah, well, so the initial rule is that all FDIC insured banks are in, and beyond that, I think for CDFIs or others, it's, I think, just forthcoming from Treasury.
In terms of I see some additional questions just relating to, again, the EIDL and how it can be rolled into the Paycheck Protection loans. I know we covered that a little bit in the comparison of how this is different, but for folks who may have joined a little later in the webinar, would you mind going through that again, particularly related to the grants that I know is a new aspect of the CARES Act as well? Maybe going through that as I see that frequently in the chat box here.
Yeah. So the background here is that the EIDL or EIDL program, as it's referred to at SBA, is the old and the kind of traditional SBA disaster loan program. And that is a direct loan that is made from the SBA to the borrower. The borrower applies online through the SBA, and then they receive the amount from the SBA. There is a new component that was added by the CARES Act that allows for a $10,000 grant to be made through the EIDL program. And the EIDL loan in general caps out at $2 million. The Paycheck Protection loan allows for EIDL loans to be refinanced as Paycheck Protection loans. But in general, they do very different things, and the Paycheck Protection loan is something you get from your bank, not directly from the SBA. As far as the interaction of the two, the EIDL loan grant it's a grant. It can be used for anything. They don't need to pay it back, and so that amount is not something that needs to be refinanced like a loan needs to be. But the EIDL loan amount, the rest of the principal that's refinanced, will become basically a grant if it's refinanced into the Paycheck Protection loan, because that outstanding principal will be forgiven if it's spent on payroll or other fixed costs.
Great. I think just for the purpose of being as practical as possible, given that applications are now available today, I know that we've covered some of the basics on payroll costs and what that includes and how to calculate the maximum loan amount. But perhaps it's worth going through one more time. Again, as that is a commonly asked questions here in the chat related to the calculation of payroll costs, as that will be the primary documentation along with the application that borrowers will need to submit for the loan.
Yep.
So for example, a few questions about Social Security, Medicare, federal and state unemployment, kind of as part of those. Maybe you can just go through that one more time for the audience, if you wouldn't mind.
Yep. So the definition of payroll cost includes any state or local taxes on compensation, but not any federal taxes on compensation. And I know that there are other provisions of the CARES Act that provide tax relief in some way, and I know that there's a deferment of payroll taxes for businesses that are taking paycheck protection loans, but you don't get to count federal taxes as your part of your payroll cost. Our definition of payroll cost, though, is fairly broad otherwise. It includes basically all forms of compensation. And then, but it doesn't include, I guess, so in addition to not including federal taxes, I think an important thing to be aware of is that it does not include any what are called qualified sick leave or qualified family leave wages. So which are the wages that you get a tax credit for under the Families First Coronavirus Response Act. So basically your payroll cost is reduced by any of the credit that you receive for paid sick, family or medical leave that are due to the new coronavirus medical leave and family leave requirements from the Families First Coronavirus Response Act. And the idea there from the members was we didn't want to have any double dipping of federal assistance for paying out paid sick or medical leave.
That's very helpful. Caleb, I think it's worth going through, again, a little bit more in detail about how the loan forgiveness formula is calculated, since that continues to be a question we're seeing a lot in the chat box, and I know there's a lot of different calculations involved. And if I can just try to break down for simplicity's sake to tee you up, the loan calculation is based on 2.5 times your average monthly payroll cost over the previous year. The loan forgiveness calculation is 8 weeks of covered expenses, starting with the commencing of the loan and inclusive of payroll, rent, mortgage interest, utilities. And Treasury has added, and SBA have added another specific layer there that says not more than 25% of the forgiven amount over that 8-week period can be non-payroll related. So with those two as a starting point, I think some of the questions are, can you not lay off anybody? What if you've already laid off and you're trying to ramp back up? Can you reduce anyone's salaries? What kind of flexibility did you include in the legislation, and how should folks think about navigating those different scenarios?
Yep, great question. So we can walk through the top line math is that your loan amount is 250% of your monthly average payroll. And so because your forgiveness and your employee retention requirement is over an 8-week period or a 2-month period, then 250% of 1 month's payroll means that you get to cover 2 months payroll and then have extra 50% for your fixed cost. Within those requirements, though, like John mentioned, there are 2 exemptions that give a little wiggle room for retaining your employees. So the employer is allowed to reduce the pay of those employees up to 25% of their prior quarter's annualized pay before seeing any reduction in loan forgiveness based on the amount of pay reduction beyond 25%. And then also, as mentioned earlier, if after the employer takes out the loan, they have already experienced some layoffs, they've already laid some workers off, then they have until June 30th to restore those workers, and that initial reduction in employees on payroll will not count against them for determining whether or not they've retained employees in order to receive forgiveness.
Well, thank you so much, Caleb, for joining us. We are just about at time, so we will begin wrapping up the webinar. Thank you all for joining today. We hope that this was helpful in answering some of the most practical and pertinent questions as the application process for these Paycheck Protection loans opens today. Thank you again. We will be circulating this recording of this webinar to all participants and registrants afterward, along with a list of resources that we hope will be helpful to your accessing of these loans. We will, as I mentioned at the top, be continuing to develop additional resources, analysis, and insights and post that on our website over the course of the next few weeks. So again, big thank you to Caleb for joining us today and taking time out of your busy day. We really appreciate it, and thank you all for joining us as well.